Hey everyone, this is Chad Smith from Reveille Wealth Management, also joined by my partner Stephen Weitzel. We're glad to share a few thoughts with you this afternoon. It's Monday, September 29th, and we wanted to come on and talk about a topic that kind of hit the financial media this weekend, circulating around CNBC originally, and then now a few other sources, was this discussion about the so-called Buffett Indicator. It's another way to look at the valuation of the stock market relative to some metric. And so, it caught our attention, and we obviously are looking at these data points frequently. And so we wanted to come on and just discuss this, define it, and then look at where we are, in the history of this indicator and what it means about the current level of the markets, the valuation levels of the markets, and is it a good time to be looking at investing in the markets in general? So Stephen, let's just quickly define this. The Buffett indicator, was kind of it was put out there, introduced as a metric by Warren Buffett back in supposedly 2001. I remember back then watching a lot of this kind of unfold when he was evaluating the markets through his lens. And of course, his lens is very different, right? He's an extremely long-term investor, but he believes in the concept of, buying something for a good price in general. So just like you can look at a stock or you can look at the market broadly in terms of some level of valuation versus, some kind of plumb line, on a price to earnings basis, for example, what are you paying for the stream of earnings you're getting, price to cash flow, or price to book value? What's the price you're paying for the value and intangible value of the company, maybe? But in this case, the Buffett indicator is looking at a very large measure of the stock market, the largest you can find, in this case, the Wilshire 5000 index, which is really the broadest evaluation of the US stock market versus the current GDP of the US economy. So on my screen here, you can see right now the current market capitalization of the US stock market, again, defined by the Wilshire 5000 index, is about $66.5 trillion. Relative to the current GDP or output of the US economy is about $30.5 trillion. And so that equation results in about a 218% Buffett indicator. So the US stock market is valued at over 2 times the US GDP output right now. So, that seems to be really high. Let's look at this in the context of history. And so this is a graph going back to the 1990s. And it just shows, how this has tracked over time. And then, Stephen, what's interesting is back when Buffett was concerned about the level of the US market versus the level of the US economy, and he was concerned about overpaying for companies back then, it was around, 140% at the peak. And of course, then that was coincident with a major market top and an internet bubble. And then in contrast, you see where it is today. So give me some perspective on what you see there and what that means for levels of valuation that we're seeing today.
Yeah, well, obviously we're in a market right now where a lot of investors don't seem to be overly concerned about fundamentals or valuations, and that doesn't mean that the stock market can't continue to go higher. But Warren Buffett being a long-term investor, he is still focused on having some reasonable timing with the way that he puts cash to work. He always has been. And in the late 90s, he was famously sitting out because he thought that, according to his own metric, this Buffett indicator, that the market was too expensive relative to the actual production of the U.S. economy. And he chose to either hoard cash or maybe buy very defensive businesses. Now, the flip side of that is in 2008, as that ratio was maybe getting close to troughing, the market had already started crashing in September and October, and I remember there was a famous Wall Street Journal um, article or op-ed that he penned at that time saying, "Buy American, I am," and
Hmm.
the using this indicator as a metric that at that time the market was undervalued. That's when he was starting to put cash to work. Now, um, at that time, it didn't necessarily mark the bottom for the stock market. It didn't up in the stock market, at least the S&P 500 index didn't end up bottoming until March of the following year. But still, from uh, from a long-term perspective, he made some great buys at that particular point in time. Um, I
Yep.
think that he would suggest right now that is this the best time to be putting a lot of cash to work for a long-term investor in the U.S. market? Probably not.
Yep.
You're probably going to expect substandard or less than average returns. Um, Now, there's probably this ratio, if you were to look at it in other countries, is probably a lot more favorable.
Hmm.
So I think that the big takeaway from this is you want to exercise some caution.
Absolutely, that's right. And from our perspective, given what we do with trend following, we want to align with what's happening in the markets. And right now, we're in uptrends across the board, and we've highlighted that, all throughout the year for the most part. And so we're positioned accordingly. But what we do want to do is understand the market environment, right? And this tells us that, hey, the market has, we all know this, I think, by looking at the markets, observing the markets, and looking at a lot of the different data that's out there, the markets have gotten to a euphoric level. There is great expectations that have been built into the market, and from any valuation measure that you apply. And really what it means is, we've been sucking in so many buyers into the market. Eventually, you get to this point where the market has priced in perfection, and then ultimately something not even doesn't even have to be significant can become a negative catalyst that changes the perspective. And so the ice has gotten thinner, so to speak, and we have to be cautious about when that ice could give way. And then, just again, as you said, just proceed with caution and understand the market environment that we're in right now.
Yeah, proceed with caution. I'd say also look for alternatives.
Yeah.
This is something that we've talked about in our monthly reviews. We've talked about it. As I've been on with some of our friends on the morning show with Stock Market TV.
Yeah, you were on
That
there this morning even.
I was on there this morning, and we were
Yep.
talking about how you just need to look for alternatives, and you find a lot of value in more of the small cap names. You find value in the international markets, and that ultimately the U.S. stock market is probably a piggy bank that gets rated maybe slowly at the beginning, right? It could be
Hmm.
gradual and then sudden to go into these other things that are not at all-time highs in terms of valuation. And so we think that investors need to be exercising some caution on how much risk they're taking right now. And this Buffett indicator is maybe just another example of that.
If you have any questions about anything related to our discussion today, or want to learn more about how we approach the markets and how we analyze everything relative to our rules-based investment discipline and our view of the world, please email us at info@reveillewealth.com, and we appreciate your time.